Hello, everybody. We made it to the end of May. Good things are going to happen in June. Yes, we got to be tactical. We got to be patient. And we can have an excellent month. Now, overall, people were quite bullish in the month of May, and that's probably because, well, all the big mega cap names are up huge. Meanwhile, if you just peek behind the curtain, you see a lot of names over here in the red. We're going to talk about some opportunities coming into the new month, first of the month, June, in today's Stock Market Brief show. If you're new here, well, welcome to the show. Make sure to subscribe, hit the like. It's greatly appreciated. We use technical analysis and intramarket analysis to get a good idea as to where the market may be headed next. We're getting right into it today. No intro screen. This is a chart that I've been sharing. This is ES, the SPOOs, S&P 500, E-minis, blah, 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 blah. Where are we? We're in a range, having a hard time breaking away from that 4,200. In the short term, we are managing to put in higher highs and higher lows, so that's a positive sign. On yesterday's video, we talked about careful if we slip back under 4,200, we may see slide back down towards the middle of the range. And you can see we came down there today and we bounced a little bit, where back up to about 4,200, 4,190 on the SPY, which was a lot of gamma exposure at that level. So it's going to be an important level to watch going into tomorrow. Overall, where are we? Well, we're right back in the range. Like I said, we're going to talk about some opportunities potentially kind of forming if you really are bullish the market. Now, if we take a look at the advanced decline line, the cumulative line for the S&P 500, you can clearly see, the effects that this bifurcation is having. You can see here on the cumulative advanced decline line, we're heading down. Meanwhile, the S&P 500 has been heading up, which is a divergence. I haven't talked about this specific cumulative line for quite some time. The last time I really talked about it was over here, where we saw a bullish divergence, where you saw the internals showing strength, whereas the S&P 500 was rather flat, kind of consolidating here. And what happened? Well, we ended up breaking to the upside, backtesting, and moving forward. So that was a pretty positive sign, and now we're looking at more of a negative divergence. So we're going to need breadth to come back into the market to really help support this move that we're seeing. Now, if I take a look here, this is the percent of stocks above the 50-day moving average and above the 200-day moving average in the S&P 500. And as you can see, the S&P 500 has been pressing higher, but the percent of stocks are clearly breaking down. Now, this is important because this can lead to the next opportunity. And you can really see that just looking at the heat map once again. I want to just reiterate that. This is the month of May, and you can see a lot of stocks are breaking down. Okay, so when I look at this, as the S&P 500 is being held up because it's cap weighted by the big names, you can just clearly see here as how price is kind of breaking down, or the percent of stocks above the 200 and above the 50-day. To give you more of a, an interesting fact here, when it says 30 here, that means 30% of the stocks in the S&P 500 are above the 50-day moving average. So that means, it could be a medium-term bullish trend as price is above it. However, if you look at this on the flip side, it's saying that 70% of the stocks, 70 in the S&P 500 are actually below that, which is not a healthy sign overall. Such bad breath, it needs a bubble gum. Okay, now, where's the opportunity here? Well, first and foremost, if we start heading down deeper, that's a pretty overextended area. So I've marked out, hey, when we get very overextended, these can mark bottoms in the S&P 500. So, we see the market cap, like heavy market caps going up, but this could create a potential opportunity for equal weight and or the smaller names to see a potential bounce if we start reaching down further into this 20% of stocks, 10% of stocks. That means we could potentially get hit in the S&P 500. But if we come down into this range, that can offer up an opportunity, meaning that we have a lot of overextended names in the S&P 500 to the downside. And then the same goes there for the percent of stocks above the 200-day. You can see that here too as well. This is the XVG. This is, just think of it as equal weight. And then you have the S&P 500 just below us. And I'm highlighting different divergences. You can see bullish divergences, and then the yellow boxes are bearish divergences. So you saw this bullish divergence here where S&P 500 goes lower, but then internals are showing strength. And then that's when the S&P 500, hey, there's something going on here. We saw move higher. This is something that was pointing out going into 2022, where the S&P 500 was pressing higher, but internals were weakening. Okay, we have a similar situation right over here going into 2023. And then right now we're building out a pretty long divergence here of equal weight versus the S&P 500. Now, this is interesting because we've been seeing the dollar rapidly move to the upside, breaking out of this channel. And typically there is a negative divergence, or sorry, not a negative divergence, a negative correlation between the dollar and the S&P 500. And the dollar goes down, S&P 500 goes up. S&P 500 goes up, oh, well, they're going flat. However, when you really break it down, I guess there are a lot of names, breaking down. Another thing you can look at here is just a bunch of different assets from an intermarket perspective. And I want to focus your eyes on the assets and then the month-to-date performance. So this is the month of May, and you can see things like crude oil, so a big commodity, down 11% on the month. Energy sector, XLE, the spider, right? Down 10% on the month. These could be potential opportunities going into the month of June because they were hit so hard and some names went really far. So we potentially may see a rotation, a potential bounce, could be a dead cat bounce, but that's something you want to think of going into this next month. So not only do you have energy getting hit hard, right, and crude oil, which is, an indicator of a, potential recession right around the corner there, but you have retail down 7%. So those are the biggest hits in the month of May. That's XRT, the spider. You have Bitcoin that was down 7% there too as well. Meanwhile, at the top of the list, you have technology leading the way, semiconductors, and the Qs, right? Mainly led by what? NVIDIA. NVIDIA's big move up, that AI, everyone's been talking about AI, really helped this moving. And to be honest, speaking of AI, you're looking at the stock AI reporting after hours, and this thing is trading right at around 31. So we'll be opening potentially down in this range, which is a 22% drop after this monster kind of blow off valve type of move. So we'll see what comes later of that. That's not the only one that reported out after hours. We had Salesforce too as well. Been on a monster move here for the year of 2023, and now it's reporting earnings, and it should probably open around, as it's trading right now, it can open anywhere, but it's down 6% in the after hours trading session. Okay, so yeah, Qs, the AI stuff, it really helped perpetuate a pretty strong move and forward momentum in the Qs. Looking at the monthly chart, we ended up breaking through and closing outside of the monthly expected move. We tagged it earlier and actually came in. Then NVIDIA reported earnings and we came back. Where did we tag? We tagged actually the quarterly expected move, and you can see price actually tagged that. So this quarterly will get updated after the month of June, and you can see price actually backed back from that a little bit. So is the move in the Qs pretty much reached its, top here for this quarter at least? So is price just going to kind of fluctuate around that 350, 355 marker? We will see. You can look at the big names, and things like NVIDIA was off 5.68% today, closed at the low of the day. We had the shooting star candle. And yeah, a move like this, it has to get digested at some point. If you're in the Discord group and you haven't seen already, go check, because I put monthly expected moves now for NVIDIA, for Tesla, for Apple. So I expanded on that for those. Take a look at Apple. We have dualies right over here, shooting star type candles, meaning that, hey, price looked really bullish throughout the day and we were like, woohoo, but then all of a sudden the bear stepped back, closing at the low of the day. These could represent potential reversal candles, but you want to get confirmation and take out the low. And then if we start breaking down, look for a reconnect of that 20-day moving average. Amazon's obviously been on a big move too, as for the month of May, it was up 18.1%, sorry. So after a move like this, these type of moves, they can get blow off valves and move higher, but they eventually need to get digested or consolidate at some point. You see Microsoft too, a very strong move, helping, really the Qs move forward. So we broke out of this, haven't looked back, left a gap over here, and it was a runaway gap where we basically gapped through and we started moving higher. We even have a gap here that ran away. So we got to constantly monitor this. We're getting fairly far extended from the 200-day and from the 50. And when we get too far extended, these aren't really the greatest areas to just be like, yeah, I'm going to go long. You can get long, and potentially get lucky, or you'd have to wait out a period of consolidation, whatever it might do, maybe build out a base, and then eventually then offers the opportunity to have a better risk to reward trade going from the long side. Google, same thing. It's kind of consolidating here sideways. It went on a monster run. We broke out of this, right? Tight consolidation, right? Remember, right? We talk about this often. Expansion leads to contraction. Contraction leads to expansion. Now we're contracting once again, potentially flagging, but we're far from the 200-day. We're far from the 50. We're far from the 20-day. And you got to understand, when we get far away from the 200-day moving average, when things get pretty extended, they snap back, right? And if they come out, they're pretty far extended, they snap back. We see that from the upside, and we've seen it from the downside too. Okay, let's move forward. Now, obviously, we talked about tech being a big leader, but there's some other sectors too as well. And if you really believe that the market is reaching, at least time-wise, near a bottom, we talked about this cycle chart. The orange is the stock market cycle. The blue line is the economic cycle. And when we reach a potential bottom in time, you typically see technology do better, discretionary do better, and communication services do better. And that's typically where we're entering into the recession. Okay, so based off of, like, you know, it's not to say that these can't go down at all, but I still believe that as far as time goes, I think we're nearing the time frame of be more certain that we are actually at that, for sure, stock market bottom. So where's the opportunity here? Well, if technology, communication service, and discretionary, we already know those are the top performing sectors for the year to date, where you have, you know, discretionary, services, and then tech up this way. Well, the next one down the list that typically does good would be industrials, and that's really typically going into, you know, when we're reaching towards the bottom of the recession, so we might still have longer to go. But I wanted to just show you what the chart looks like on Dow Jones Industrials. We had this, you know, strong move, it contracted, we expanded, and now we're potentially flagging again, holding above the 200-day moving average. So as long as we can hold above the 200-day or this swing low, that at least opens the door to potentially think that, hey, we may be able to come tag back up into this area again. Remember, if you just look at this, you know, as far as just a range, we come to the top, we come back down to the mid, bam, down to the bottom, we come back up, try to get to the top. So we're really just range trading overall if I redraw it out like that. So right now we're in the middle of the range. And if we start breaking down this low, okay, start thinking that we might be able to come down here. But if we can hold this at least is an opportunity to potentially head higher. So that could be an opportunity there going into this next month as well. Interestingly enough, when you look at something like Dow Theory, where you look at transports and industrials, transports is up top, industrials are down beneath us. This could give us some insight into potential moves as well. So, for example, like Dow Jones Industrials, when it starts making a new high, but yet we're not getting a confirmation on transports, it could potentially be a warning sign that, hey, industrials, you know, transports are telling us something right now. Maybe we're going to see industrials pull back. And you can see that divergence there played out to the downside. Now over here you see, yeah, well, transports are showing us some strength here. We have a little bit of a lower bottom there in the industrials. Maybe transports are trying to tell us that we might get a move higher. Well, boom, we got to move higher. And you can see the negative divergences play out multiple times. Negative divergence, the recent one was right here where we pointed out we had a lower high in industrials and a lower high in transports, a higher high in industrials, and we started moving down. Well, now I just want to call out that, yes, the chart on transports, it looks pretty weak. It looks like it could be potentially head and shoulders where if we do break down, boom, that could be pretty bad. Okay, that's fine. But as it stands right now, we have a low and a higher low. And the higher low would be a higher low even if we drop further. Where we have on industrials, we do have a low and a lower low, very similar to how we saw here at the October bottom. So if if transports can get back above the 20-day moving average, boom, that might give us indication that, hey, industrials may be a place to be where we see a pop higher, as we stated, to back to the top of the range, potentially even further. If we go on, let's take a look at more broader market like the NYSE. This is the New York Stock Exchange. This thing has been kind of breaking down here. Remember, we identified a potential change in trend over here, and you can see the market has followed through on that trend. So it would be nice to see this turn up. I would like to call out that there is a positive divergence building in the NYSE McClellan oscillator, where we have a low and a higher low, where price is a low and a lower low. And we've seen stuff like this where, for example, you have matching lows, you had a higher low there. I think we've seen one, yeah, like right here, right? So you had matching lows. And if I had a candlestick chart, I'm pretty sure these lows were undercut. Bam, right there. So there's been positive divergences, but every time we saw, like for example, right here too, boom, boom, we saw this move up higher. So there's 3 positive divergence. When we see these, typically it means that we can potentially bounce. Now, the only thing that I don't like specifically about this positive divergence is if I look at this 250 level over here, and I just kind of take a line and I go to the side, go like this, right across the screen. When we had those positive divergences that I just highlighted out, you know, right here, right here, right here, So I'll use those for example. I'm not going to look at for all of them, but they all reach down to around minus 250 on this. So this is far from that. So what I'm thinking is, hey, if we maybe do get an exaggerated move or breakdown in the NYSE, and it takes out this low, and this holds, that means this breaks down to around that 250 marker. That would actually be a positive divergence right there. And that would be setting up for a potential opportunity where maybe when this turns back around, that could give us some insight saying, hey, now I'm looking to go long or cover some shorts if you're short going into whenever that potentially takes place. Now, let's take a look at the new monthly expected move for the S&P 500. So remember, SPX, where did it finish for the entire month? Unchanged. It was a big chop box. We already talked about this. We have the PPO, price percent oscillator, starting to curl back up. Saw some more volume than last month. So it's looking good, okay, overall. However, you want to be mindful that, hey, this monthly candle was known as an indecision candle, right? The range would tell you that. And we basically open, like I said, unchanged. So we have a big authoritative candle. We have a smaller body candle, and then we have even a smaller body candle than that. So this right here is price telling us that, hey, we're getting indecisive, things are contracting here, potentially leading us very soon to an explosive move. It could be a very big move. Now, you can look at this and say, hey, it's a bear flag. Okay, that could potentially be where we break down then, is a bear flag. So if we take out the low, potentially tag the lower monthly expected move, 4,000, that can open the door back into the bear market territory and potentially the lower quarterly expected move. You can also look at this as a potential, hey, we're flagging, okay, we're just waiting for that kind of explosive move, right? Maybe it shakes and bakes, and then boom, we see a big move, and that, you know, validates a bullish crossover on the price percent oscillator. So that would be an opportunity there too as well. Remember, the 5-period monthly EMA, that is currently trending up. So if we start breaking down beneath that, definitely have a little bit more caution. If you're wondering what these numbers are on the screen here, this is the monthly expected move levels. And then you have the quarterly expected moves on dashed thick right there. And then the area is that red shaded area that's lighter on the screen. That's measuring 20% from the high down. So that means this right here is considered bear market territory, as it's 20% from the high, down 20% from the high. Now, if I look at the daily time frame, we talked about keeping above that quarter to day anchored VWAP right here, right? We came in, we filled this gap. We still have this one gap above us. So I still think that that's a very possible scenario that we can come back and hit it. I don't rule that out. It's just nice that we're holding the quarter to date. As long as we hold this low right over here, that's going to be a positive sign in the quarter to date. So the bulls still got momentum when we look at it from this perspective. When we zoom in even closer, this is where we get a lot more tactical. This is the 15-minute chart. Now, yesterday we talked about a potential bull flag, boom, right here, but we said we needed to get above where? We needed to get back above this high over here and the week-to-date anchored VWAP. Now, this is why you need to be patient, because what? We gap down, okay. Does that mean you go long right here? Why? Why would you go long right there? To get lucky, potentially, maybe, but we're still below a quarter-to-date anchored VWAP. Then price started falling a little bit more rapidly, as we discussed as to why that could potentially be when we cross down through here on ES, how it opens the door lower. Well, we came down to where? The 5-day moving average. So the 5-day moving average, it's flat to neutral. So the longer we hold above it, we're going to lose more data over here, and this is going to start turning up, which would be a positive sign. So as it stands right now in the short term, bulls have obviously taken charge. They're above that 5-day moving average. They're above the month to date, which the month is over. So we're going to have a new month to date starting tomorrow. To be more bullish, you want the week to date to be recaptured. And this is where it gets very interesting. Look at the weekly expected move. The weekly expected move brings us down to 411.95 and as high as 428.09. We have only 2 trading days left, right? Tomorrow and the next. And this is crazy because this is a bigger expected move than the prior week, and last week we didn't have a holiday, okay? So this week it's a shortened trading week, and we have a bigger expected move, and we're right there in the middle. We have jobs reports coming out. We have other data. So this is going to be important to watch. So from a bearish perspective, I want to just call out that this could be potentially flagging within an overall bullish structure, and that could potentially open the door lower to touch the lower daily expected move. And if we break down for a full measured move, that can really take us down to around the 411.95, which is the lower weekly expected move. Now, from another perspective, if I measure from here to here and retrace it down, this right here is the 50% retracement, right in confluence with the 5-day moving average, and we bounce from that level, but the week to date is holding as resistance. Okay, so if this low gets taken out tomorrow, careful, obviously, because that comes down to here, which is the lower daily expected move. It would be in confluence with the lower trend line of this channel, and it would be the 61.8% retracement level down here too as well. So if it comes down into here, people might be like, yep, the market's crashing. Okay, we'll just pay attention to how price trades in this area, right? Be patient to see how it trades. And if it starts basing out, if it starts building strength or more volume comes in, potentially you can play it back up to the top to see where the week-to-date anchored VWAP is. And then potentially that sets us up for still an explosive move right back up to the upside. So that's kind of how I'm looking at it going into tomorrow's trading day. That's all I got for you on today's show, everybody. We covered a lot. Obviously, a lot of bifurcation still. Be careful out there. Be tactical. We're still stuck in a range. Remember, patience, especially coming into June here too as well. We want to have a good, solid month. See you later.